Hello, ladies and gentlemen. This is Jesse Colombo, and I'm excited to announce today's presentation. We have many new faces in here, many people who are my own followers who followed me on social media for many years and also who found me through my column on Forbes.com. Wrote a few columns this weekend, and it's quite appropriate that I'm teaching this webinar today on this big Forex day. Big moves happened in Forex and futures, many of which I discussed and foresaw this weekend on this column. Why global currencies may be on the verge of a big move. So, of course, I'll be discussing that toward the end of this presentation once I teach you the basics, and we can have a Q&A discussion toward the end, and we can discuss and I can show you some charts of what happened today. Very exciting. I'm pretty pumped and energized, so definitely be very interesting, but we'll discuss the basics right now. So today's presentation is called How to Trade Forex and Futures Like a Hedge Fund Trader. And I've done other presentations where I focused particularly on Forex or currencies, and this time I'm going to be integrating the futures market a little bit more just to keep it interesting for everyone and discuss how I use various markets, including futures and Forex, to forecast one another and play one off another. So we'll discuss the basics of those. But first, I'm going to discuss the obligatory risk disclaimer that we always do. Basically, there's a high risk involved with all forms of trading, whether it's futures, stocks, bonds, Forex. And the idea here is we're not giving you investment advice. We're not telling you what to buy or sell. I'm not advocating anything in particular. This presentation is for educational purposes only. And if you want, I'll give you a few more seconds to read through. And you also read this disclaimer when signing up for the webinar. So I think we're all on the same page, literally and figuratively. So I'm going to discuss who I am for many of you who don't know, or many of you do, but we'll go over it again. My name is Jesse Colombo, and I am an economic analyst and researcher. And I first became known because I predicted and warned about the global financial crisis starting in 2004. And this is when I was a university student. I warned about the housing bubble and the credit bubble that was developing in the United States, and I built a popular website called stockmarketcrash.net, and I ran this website throughout college. And in 2005, this website was recognized by the LA Times as one of the 4 most highly trafficked housing bubble related websites. And actually in 2005, around that same time, if you Googled the term housing bubble, my website came up #1. I was just 19, pardon me, just 19 years old when I was running this site. And then when it all blew up in 2008, I was included in one of the lists put out by the London Times called 10 People Who Predicted the Financial Meltdown. And then since then, I built a following because I noticed new dangerous economic bubbles developing across the entire world. So I started warning about them in 2011. Via my own blog and my own social media. I built a following, many followers on Twitter and Facebook, etc. And then Forbes saw what I was doing and took interest and said, hey, would you like to write a column on Forbes.com? And I've been doing that for about 1.5 years, and it's been quite popular. And recently I partnered with Cyber Trading University to teach Forex and futures webinars. And these topics integrate very well together because I am actively following futures and currencies and Forex and everything along with my studies of bubbles. And they're quite interlinked, as we may discuss toward the end. So they are not mutually exclusive for certain. So I just want to discuss what is Forex for those of you who do not know. Forex is a term used to describe the international interbank currency market and the trading of these currencies. People trade them for profit and also to hedge themselves and also to convert overseas revenues. And Forex is a decentralized market, unlike the stock market or futures where they trade on a single exchange like the New York Stock Exchange or American Stock Exchange. Forex does not have a single market like that. And most of Forex trading volume occurs in an over-the-counter manner where different banks trade with each other via dealing networks. You'll have JP Morgan trading against or trading with Goldman Sachs and Citi and so on and so forth. Pardon me. Just have a little bit of a cold because of the horrible New York weather. Anyway, Forex or currencies are the most actively traded financial market in the world with over $5 trillion worth traded per day. And that liquidity is very beneficial for traders because they can move in and out very quickly. And one second, someone is asking me if this webinar will be recorded. Yes, it will be recorded and posted on YouTube, and we're going to be sending out an email to everyone who registered so that you can review and watch it over again. So do not worry if you missed part of it. You'll definitely be able to see it via YouTube. So the idea here with Forex is that currency exchange rates can be charted and traded. If you take a trip to Europe and you convert your dollars, or let's say if you're in the UK and you take a trip to the United States, you convert your pounds into dollars, there's an exchange rate. And this exchange rate is constantly fluctuating, similar to the stock market or the bond market. Even though many people don't think of it in those terms, they don't realize that it's a financial market just like any other. That's what it is. And you can profit, and traders do profit on these fluctuations, assuming that they're correct in predicting which way these currencies will fluctuate and their exchange rates. So what you see here on this screen is a chart of the euro versus the US dollar. And what you can see on the y-axis on the right side of the chart is the exchange rate. So I made this slide a few days ago when the euro was quite a bit stronger. It's fallen significantly in the last 2-3 days. But you can see that the general idea here is that right now or at least in that chart, it was at the euro. 1 euro was worth 1.1073 US dollars. So if this chart is dropping, it means that the euro is weakening relative to the United States dollar. And vice versa. If this chart was rising, it means that the euro is gaining in strength relative to the US dollar. And traders are constantly trading and predicting and profiting from these fluctuations among different types of currencies. And there are many famous Forex traders who became extremely successful, largely through Forex, among other markets, of course, but some notable examples are the infamous George Soros, hedge fund manager. And one of the reasons why he became so notable as a Forex trader was because he essentially broke the Bank of England on Black Wednesday, September 16th, 1992. And what he did was he bet significantly against the British pound, betting that Britain was going to leave and it was called the European Exchange Rate Mechanism, or ERM, which connected the pound to other European currencies. And this is the precursor to the euro as we know it now. And he bet that Britain was going to leave and it was going to cause the pound to crash. And he was right, and he made over $1 billion as the pound crashed within a day or two. Of course, he had a hedge fund, but the idea is he got to that point of building up his hedge fund successfully and attracted capital because he was so adept as a trader in the global financial markets, including the currency markets. And what's interesting is that the Forex market or currency market is so much larger than it was back when he broke the Bank of England back in 1992. It is a much more liquid, actively traded market. So you have hedge fund players who are moving massive quantities of capital in and out on a day-to-day basis, and that's why it trades $5 trillion plus per day. Another notable example is Bill Lipschutz. another hedge fund player. He made $300 million in 1 year from Forex. And another one is Andrew Krieger. He made $300 million betting against the New Zealand dollar in 1987. He bet it was going to fall. He was against the U.S. dollar and other currencies, and he was correct, and he was rewarded with $300 million. So, and there are countless other successful traders who are making much smaller amounts relative to these famous traders, but still very significant and who earn healthy profits, who people you don't even hear about, and yet they're doing it. So now I want to just discuss briefly what are futures, because we'll have to know for some of the next slides and for the sake of this lesson. So futures are derivatives contracts that allow traders to profit from or insure against movements in various markets. And there are so many different futures markets out there, it's just mind-boggling. But some of the most common are commodities like oil and wheat, also stock market indices like the Dow and S&P 500. You hear the Dow went up, the Dow went down. The Dow is an average. It's not an actual stock that you can buy or sell, but using futures, it allows you to bet on the overall market or to bet on the overall average. Let's say if you don't have an opinion on a single stock, you just want to buy or bet against the overall market, you're able to do that with futures. And interestingly, there are even futures on currency exchange rates, like I showed you before, the euro versus US dollar. So there are different ways of trading Forex. You can trade Forex via trading actual currencies, cash currencies, as is commonly done, and you can also trade these futures on those exchange rates. So there's so many different ways of skinning the cat, so to speak, in the financial markets. And I'm going to show you some examples of how futures are used, even though they seem like a very exotic concept and most people off the street have no clue what they are. They're very important, of course, and they're not as hard to understand as you think. For example, farmers commonly use futures to preserve or protect the value of their harvests. They'll lock in the value. Let's say if they're a wheat farmer, like we have here in the heartland of the United States, and they benefit from high wheat prices, and conversely, they get hurt by low wheat prices. So if wheat prices fall and they were not insured against that fall of the value of their wheat, they stand to lose money. So what futures allow them to do is to short wheat futures, and basically they lock in their price so that if the price of wheat drops, even though they'll receive a little bit less revenue when they actually go to the market to sell their wheat, they'll earn it back in the form of the futures. So it's like insurance. Basically, they get covered. Instead of having an insurance company, it's the futures market that pays them out. So instead of being a risky thing, futures actually allows people to reduce risk if they're using it to hedge. That's called hedging. On the other hand, if you're interested in taking on risk, you're a speculator who's looking to profit from price movements, you can buy wheat futures. If you expect there's going to be a bad harvest or there's been massive damage of the crops and you think wheat prices are going to rise, you can go into the wheat futures market and buy a contract or two, or you can buy 100 contracts, and you can stand to make significant amounts of money, or also lose if you don't know what you're doing, of course. And if you expect there to be a massive a bumper crop, for example, wheat, where there's just so much produced, and you think wheat prices are going to drop, you can short wheat. You can bet that it's going to fall, and you can make money either way. And it works the same way in the Forex or currency market. If you think prices are going to go up, you can bet in that manner, and vice versa. So it's nice to be able to profit from whether the market's going up or going down. And futures prices, and I'll show you some charts, futures can be charted and analyzed using technical analysis, which I'll discuss, just like stocks can, just like currencies, and just like bonds. So if you have this knowledge, you are able to analyze all different types of markets. And many people have no clue, how would you even predict a market like wheat, or diverse markets from wheat to oil to treasury bonds? How would you even do that? Well, there's a common technique called technical analysis and of course, other types of analyses, which I'll discuss, I'm sure, in future webinars that you can use to predict and forecast and trade these markets. And I'm going to touch upon some of those ideas today. And many of you, I'm sure if you're old enough, have seen the movie Trading Places with Eddie Murphy and Dan Aykroyd back in 1983. This is one of my most favorite movies. I watched this as a kid before I even knew what futures were. But I saw it and it piqued an interest in me. It's one of the reasons why I started looking into the financial markets. Believe it or not, at age 15. It sounds funny, but I was a little bit of a precocious kid. And I was very interested. I said, how did these people become wealthy from trading corn and wheat and these other markets? It just doesn't make sense how you can make money on that. And I looked into it further, and I started, of course, not just based on this movie, but it definitely generated some interest in my mind. So, and they were trading futures in this movie. That's really what it is. That especially back up until recently, where a lot of the futures trading and commodities trading occurred in the pits, like on a trading floor, a circular pit where people stand around and basically it's basically a live real-time auction market that occurs throughout the day where there's price discovery going on, where that's what determines the price of these futures like corn and gold and oil and treasury bonds and also S&P 500 futures, just from people looking at each other and yelling out orders. So it's pretty incredible. Now everything's moved. There's been a migration toward electronic trading, of course, since then. But there are still trading pits, but their days are, for the most part, numbered right now. So you can see futures can be charted just like stocks and bonds. Here's a chart of crude oil futures. You can see prices fell precipitously since the summertime, 2014. Something that I warned about publicly. I warned 260,000 plus people on my Forbes column that there was going to be an oil crash, and I wrote that in early June 2014, and sure enough, the peak occurred just within days, and then it's plunged. So, pardon me. You can see corn futures trade in a similar manner. In this case, in the y-axis, it's priced in cents per bushel instead of dollars per share as you would have with stocks, but it's really the same concept. You can see live cattle here trades in cents per pound. It's actually live cows being bought and sold, and you can profit if you think meat prices are going to go up. You can profit from that. If you think meat price is going to go down, you can bet against it. Here's the 10-year note. This is U.S. Treasuries, U.S. Treasury bonds and notes. There are futures on them, and if you're a skilled economy watcher and Fed watcher and inflation watcher, you can successfully trade bond futures, and there are people who do nothing but trade bond futures and make millions, if not billions of dollars per year doing just that. Here's a currency future on the U.S. dollar index, where it's basically like, you know how there's the Dow and the S&P 500 for stocks. Well, there's the equivalent for the U.S. dollar, where the value of the U.S. dollar is aggregated against or averaged based on its trading partners. And you can see it comes up with a value that tells how strong or how weak the U.S. dollar is. And you can trade futures on that. Pardon me. All right, so currencies and futures have a lot in common, which is why I follow them very closely. And in my mind, I don't really have a very clear delineation between currencies versus futures or then stocks. For me, I just think of them in terms of global markets, and because there are so many, they're so interrelated, as I'll show you these relationships shortly, that for me, I don't think, oh, I'm a stock trader or a stock analyst or a futures analyst. For me, it's just I follow markets, and they're all trading amongst each other. So one of the things that they have in common is that both markets, both currencies and futures, as well as stocks, are driven by the psychology of market participants. There is no magic formula. There's no exotic formula that causes the price to change for these markets. It's psychology. It's people buying and selling, and they may be buying and selling based on rational information or also irrational information. They may be wrong. Like in the case of a market bubble, you have people bidding up the value of an asset to the moon because they think it's going to go even higher in the future, or that it's going to stay at a permanently high plateau, and yet if they're wrong, prices come crashing down. So markets move very often on the whims of these participants. And because of this, because of how sensitive markets are to psychology of market participants, technical analysis or analysis of price patterns, volume, etc., which I'll show you shortly, works for all of these markets. And a skilled technical analyst can look at the charts of any market without even knowing what it is. You don't even have to see the name of it. It could be live cattle, lean hogs, treasury bonds. You can show me that chart, and I don't even know what it is, and I can tell you where it is likely to go just based on probability. I can't guarantee and say this is going to go here by then, but you can start to spot common patterns that show up over and over and over, and that's because at the end of the day, the common denominator here is that it's humans who are trading it. And I know, of course, yeah, there are machines and algorithms that are now trading, but it's not a completely robotically driven market. There are still humans who are deciding how to allocate money in a portfolio and where to allocate it and when to allocate it. So the human element will never go away. So I just want to discuss some basic technical principles, and even though they are basic, these are powerful principles, and there are some people who only trade just using these principles alone, and very often in my own analyses, I try to challenge myself to try to predict the markets or forecast the markets as accurately as possible using the least number of indicators or other data as possible, because it's a challenge, and if you get to the point where you're experienced, you could be able to just look at a chart and have an idea of where it's going. So even though it's basic, it doesn't mean it's not powerful. So one of these concepts is support, where you'll see very often at a major round number, you'll see a market keep on falling to a similar or the same level over and over and over and over. And that's not random. And that's because many market participants are watching common levels, and they place their stop loss orders and their buy orders and sell orders at specific points on a chart because they're watching charts. Even if you may not watch charts, or some traders do not believe in charting or technical analysis, there are enough market participants who do believe in it, and that's why I believe everyone needs to at least be aware of them. So for example, I'm showing you, this is a chart of copper, and you can see on the y-axis it just shows dollars per pound. So you can see there was a common number where the market, where copper kept on falling from much of 2010 all the way up until 2014, where it just kept on coming back down to $3 per pound and kept on bouncing and bouncing and bouncing and bouncing. And you had so many market participants were watching that one level, and that's what made it significant. And then eventually, once it broke below, that was a sign. It was basically a sign to sell. It was a sign that was likely going to be further declines ahead. And I was watching this in real time ahead of time, and I wrote this publicly. I said, if copper falls beneath $3 per pound, it's likely to keep dropping, and that was going to be the trigger where it drops below that threshold where you may want to consider taking on a bearish position, or certainly not being long copper or copper stocks. You don't want to be in them if copper drops below this level, because the market could sell off in an avalanche. And also, let me backtrack a little bit. If you're aware of a support level like $3 per pound in copper, you're able to trade or go long. You're able to buy every time it touches that. And if you expect a rebound, you go long, and you could play the pop as it rallies. And then let's say once it finally does drop below, you can have a stop loss order right underneath where it gets you out of the market, where, okay, it dropped below, get me out, all bets are off, you take a small loss. But most of the time, if you're aware of that number, you'd be able to play these bounces, and some of these ended up being worth almost 33% on the underlying copper trade. So It's definitely pretty powerful. And the other principle is resistance, which is it's the inverse of support. You can see this is the Japanese yen. So I'm showing you very diverse markets, but the same principles apply. Doesn't matter what it is. And you can see in early 2014, which is toward the left of the chart, you can see the Japanese yen kept on rallying to the same point, or pretty much around the same zone. I believe it was at 0.99 if you look at the y-axis. Kept on trying to break above there, just couldn't do it. Kept on selling off. And this happened so many times for a good 6 or 7 months. And if you were interested in shorting, and every time it bumped its head there, you could have shorted and played the downside and made some money on the downside. And then finally, starting in mid-July, the Japanese yen just proved to the market it was unable to break above that resistance, and it finally succumbed. And then it just sold off significantly since there. And then recently, in the past few months, it formed another resistance at 0.8600. This is against the US dollar, of course. And you can see, kept on bumping its head. And I made this slide a few days ago, but since then, the yen has fallen a bit from here, which is something I wrote in one of my columns. So you can see the odds are against the market if it has overhead resistance. And the idea is you want to take the path of least resistance. So if you have a major resistance overhead, the path of least resistance is down. So it biases the market or currency to the downside unless it can finally break above that ceiling. Okay. So now I'm just integrating the two. You can see support, resistance. Now I'm on to a different market, gold futures. It's just one of the many futures that exist out there. And you can see for the past 2 years or so, gold has been trading in a range with a $1,400 resistance overhead and a $1,200 per ounce support underneath. And it kept bouncing back and forth, back and forth. And if you were aware of these major round numbers and the likelihood of it bouncing and hitting and correcting, you could have played this trading range. So now I'm waiting for a break above or below there. So once it finally does break one of these two levels, it's probably going to keep on moving in the same direction. And today, since the US dollar rose significantly, it pushed gold right underneath 1,200. So I'm watching this nascent breakdown because I suspect, I'm not predicting, but I suspect, and I'm just watching this as a speculator, that there's a chance that gold could keep on dropping as long as it stays underneath that $1,200 support. Because when a market falls underneath the support, that support becomes the new resistance or a new ceiling. So right now, 1,200 is the ceiling, unless it can break back above and then negate that sell-off. But right now, I'm very concerned about gold dropping, and it could be an opportunity to short gold. Once again, not investment advice. I'm not saying you should do this, but I'm just saying it's worth watching. Another technical principle, and here this goes back to what I was saying about support. Well, there are also support lines that are on a diagonal, and they're called uptrend lines. So you can see this right over here. This is the US dollar index, and it kept on bouncing off of this line. You can connect two major lows, and it'll oftentimes form a line like this. And I showed this to my followers, and I think I discussed this in a few columns in the last few months, where I said once the US dollar index hits that level, it's likely to bounce off, and it could be an opportunity to go long or buy US dollar futures or trade it via the Forex market. And also, a rising dollar is usually bearish for non-US currencies and commodities. I'll discuss these principles in coming slides, but I just wanted to make sure we're all on the same page with these basic principles before we go to the more advanced ones. So trend lines act as a support level, and they basically act as a floor. Even though this floor is not a horizontal floor, it's a rising floor, but it's still a floor nonetheless. And now here's the opposite. I'm looking at the British pound, and this is a downtrend line, which acts as resistance or a ceiling. And you can see it's on the diagonal. It was sloping downward, and every time the British pound touched that ceiling, it sold off even more and could provide the opportunity to bet against the British pound and bet that it was going to fall even further. And this happened many times. It kept on bumping its head, couldn't break through, and then kept on falling lower and lower. And many trends throughout financial markets, whether it's lean hogs or bonds or Japanese yen, will follow these principles. Even on intraday, even if you're a day trader and you're looking at the 5-minute scale, you will see stocks follow those trend lines. It's not a rare occurrence at all, and you'd be surprised how few people are aware of it, even though it's a simple concept. Some people who are aware of trading are aware of these concepts, but there are many PhD economists, even from Harvard and Yale, who you'd be surprised do not even know the basics of technical analysis. And it's almost like a form of intellectual snobbery, where they think they're above that, and technical analysis and price analysis is beneath them because it doesn't involve complex equations. They're like, what? It could not be as simple as just drawing a line in a chart. And of course, there's much more that goes into the analyses that I do, but this will take you quite far. And there's so many people who just follow fundamentals alone, just news alone, who are unaware of this, and they're at an extreme disadvantage. So I'm getting some questions. I'll definitely have a Q&A session toward the end where we can discuss. We can have a greater discussion once I get through all the basics. So here's another technical principle of trading ranges. It's basically, like you can see the Japanese yen here on the left side of this chart, bounced around between a support level and a resistance level. It just kept on bouncing, very similar to what we've been seeing for the last 2 years in gold when I showed you that chart where gold was between 1,200 and 1,400. You can see the same thing right here in the Japanese yen. And once you were aware of where the support was, which you can see by looking at prior lows, and you can find resistance levels by looking at prior highs, you know for the most part where it's going to bounce and where it's going to sell off, and you can play the trading range. You can do that all day long. And my trading friend who works at Cyber Trading University, Rich Lepis, places a very high emphasis. When he's trading intraday, he's trading stocks as a day trader, he buys and sells trading ranges all day long. He just goes in and out, in and out, in and out, pocketing 20 cents or so every time he does it. But when you multiply that by 1,000 shares or more, that's hundreds of dollars every trade. So the same principle applies in Forex or futures or stocks. Here's another principle, it's closely related, of consolidations. This is the Australian dollar versus the US dollar. And you can see back this past summer there was a trading range in the Australian dollar. And once it broke below that trading range at 0.92 against the US dollar, it broke in early September, that was a sign that there was a major change of trend. In this case, there was a technical breakdown. And if you're a technically oriented trader, you would know to short here, or you would consider taking on a bearish position, assuming other types of indicators that you maybe look at or other forms of analysis basically confirm that breakdown. And I was watching it in real time as it happened. And you could have made a decent profit as it moved down to its next trading range or consolidation zone. And basically a consolidation is a pause before another big move. So it's the equivalent to a runner. Let's say if a runner goes for a sprint, they have to take a few moments just to pause and catch their breath before they start sprinting on in the same direction. Markets do the same thing. So you can see the Australian dollar, in this case, it wasn't sprinting forward, it was dropping, but it's the same principle. It works in the upside as well as the downside. It fell, took a breath, and then when it broke underneath that support level at 0.86 in late November, continued to fall. Could be opportunity to short. It happened again in late December and early January, and then it broke below 0.8. Another opportunity to short. And now it started doing it again in February, and then in the last 2 days, it broke below there again. And sure enough, I'm not saying to short this or anything, but I'm wary of a technical breakdown because that's what it is. So especially when you see the U.S. dollar rallying, which is bearish for the Australian dollar, which I'll discuss those inverse relationships in the coming slides. But it really is quite simple. I mean, I know it seems like child's play, but you'd be surprised how few sophisticated people, I'm talking about people who work for major international banks, investment banks, are not aware of the most basic elementary concepts. And someone's asking me, does a consolidation mean hold? I would say that you could say it means hold. It just means that the market is in a holding pattern as it waits for its next trigger or its next directional move. So you wouldn't necessarily want to have a trade on until there's a confirmation, usually in the form of a major breakdown or a breakout. So it basically means that the market's just in a trendless pattern and it's just waiting for its next move. It's basically catching its breath. And very often, consolidation patterns lead to moves in the same direction as the move that led into that consolidation pattern. So it goes back to the runner principle. The runner's moving forward, and he stops and then starts running forward again. So it's the same thing. A lot of these consolidations, you can tell in advance which way it's likely to break out based on the prior trend. So many of these consolidations in the Australian dollar led to breakdowns because the prior trend was down. Of course, that initial trading range back this past summer, the prior trend was up. And in general, these are continuation patterns, but not always. I'd say it's about maybe 60, 70% of the time, but not 100%. But that's fine because you're looking for the confirmation in the form of breakdown or breakout, and you would not have been led astray by using that principle that I showed right here in the chart. So I just want to discuss a few chart patterns that I watch. Once again, the concepts may seem very simple, but I'm using these all the time to call very big moves that people are asking me, how did you know that was going to happen? I'm publishing this in Forbes.com, and you'd be surprised these top strategists for these banks are completely unaware of the most elementary patterns, and they're racking their brains, they're looking into equations, and they're looking to all sorts of sophisticated analyses, and they're completely missing the forest for the trees. So because they're overlooking something like this, and one of the patterns I find over and over and over are pennant patterns. A pennant basically looks like a small triangle. In this case, on the U.S. dollar index, this is a bullish pennant because the prior trend that led into these triangle pennant patterns, the prior trend was up. So it means that it's like when it finally breaks out, it's likely to keep moving on in the same direction. And you can see there was a pennant in early December. When it broke out of that little triangle, it made a sharp move up. And there was a pennant recently that formed starting in late January and throughout February that recently broke out. And I made this chart just a few days ago, and the dollar index is up significantly in the last 2 days. I'll show you charts at the end. I've been showing this all over the place, all over social media. I said because of that pennant pattern, that tells me there's likely to be a big move, and market participants were waiting for some sort of a catalyst to come, and that causes the currency market to basically stop its consolidation and start moving again. And it moved in the same direction that led right into that pattern. So those are bullish pennants. There are also bearish pennants. In this case, this is on crude oil. You can see same principles. Doesn't matter if it's the U.S. dollar or crude oil or lean hogs. And I showed, I'm not just showing these patterns in hindsight, even though you're seeing in hindsight right now, because I showed these patterns in advance to my followers, and I showed it on my column as they were forming. I showed crude oil after it had some sharp drops in December. I questioned, I said, looks like it could be forming a pennant, bearish pennant, because the prior trend was down. And if it breaks out to the downside, that would be the confirmation to sell. It could fall even further from here. And in early December, after that big drop, it was caused by OPEC saying that they were not going to cut production. Most market participants, many people in the financial media, thought that was the bottom. They said, this is it. We've had the big washout. Oil sold off. it's time to start looking to go long and start trying to play the upside now. But I saw that pen and I said, uh-oh, that is not good. Not that I cared. I mean, I wasn't long oil. I had been warning that oil was going to crash, so for me, it just confirms, it makes me look good. But when it broke below, that was the sell signal once again. So you get repeated sell signals, even though the trend was already well underway for a good 5 months. You get those continuation trades, and they tend to be high probability trades where if you're trading futures, you can short once the pennant breaks down. And you got 2 opportunities like that. Another pattern that I find over and over is a wedge pattern. It's another continuation pattern. I'm looking at the New Zealand dollar right here against the US dollar, and you can see this past fall and early winter, it bounced around and basically converged, and you can see the support line was a horizontal line underneath the price action, and then you can see there was a resistance line that was in the form of a downtrend line, and basically you connected the highs and it converged together, and that told me there was going to be a move. It was going to be another directional move, and it finally either breaks out or breaks down. So the prior trend was down. The trend that led into this pattern was down, so it increased the probability that when it finally moves again, it's going to keep on moving on in the same direction. And that's what happened. It broke down, and you could have caught a move from around 0.76 to 0.72, which can be a significant profit depending on how large you trade and with what kind of leverage. And then it eventually rebounded back to this level of 0.76 because, you know, as I discussed earlier, what was once a support becomes a resistance or a ceiling once the currency of the asset is underneath that price. And actually in the last 3 days, the New Zealand dollar bumped its head right at that line and is now sold off significantly, which is another scenario that I expected. I'll show you in my column shortly when we go to the Q&A session. So they're simple concepts, but they do work, and I like simple. I'm all about the KISS principle. Keep it simple, silly, or stupid. So I take this minimalist approach where, why am I going to pile on all of these other indicators if I can do it with the bare minimum possible? Not that I'm doing it to be lazy, but because it makes it less confusing, and it makes the system more robust when you don't have so many other indicators there to complicate it. And also, many people follow technical indicators, but you have to realize these indicators are derivations of asset prices that you're looking at. So all they're doing is they're plugging in the price of the New Zealand dollar or oil or whatever you're looking at, and they're putting it into a formula, and they're producing an oscillator or a line that moves up or down. But if you're skilled enough and experienced enough, you don't need that, because you can just look right at the chart and look at momentum visually, and you can tell where it is based on support and resistance, and if it's overbought, oversold, if it's extended, etc. If it's at a major psychological level, you can eyeball it. And that's something I've been really trying to train myself to do, is to go as far as I can go and challenge myself with the minimum as possible. So now I'm going to discuss intermarket analysis, and this is where we basically integrate futures and Forex and other markets and then try to wrap in technical analysis into this. This is where it gets a little more interesting now that the basics are over. So intermarket analysis is when you use one financial market to predict moves in another related market. And it was first discussed in detail back in the 80s by technical analyst John Murphy, and he wrote some very good books called Intermarket Analysis and related titles. And I've taken it a bit step further, added my own techniques and ideas, and certainly a lot has changed in the past 3 decades. But I'm a big fan of intermarket analysis, and not many people are aware of intermarket analysis. They just tend to look at one market, but they're not aware of relationships among different markets. And intermarket analysis uses established relationships and correlations among different currencies and commodities, bonds, equities, etc., to generate signals. If you can find a chart pattern or signal in one market, you can oftentimes use it to forecast the moves in another related market, as I'll show you the charts shortly. So I just want to let you know some of the most important intermarket relationships to be aware of. The number one most important by far is the U.S. dollar versus other currencies and commodities. And this is an inverse relationship, meaning when the U.S. dollar goes up, other currencies from the euro to the pound and also commodities from copper to gold to oil fall, and vice versa. Weak dollar is good for other currencies and commodities. Another relationship is commodities versus bonds. When commodities go up, it tends to indicate that inflation is on the way, and bonds do not like inflation because bonds pay a fixed dollar amount income payment, and inflation erodes that. So when commodities prices are going up, it means bonds typically tend to sell off, and vice versa. And when commodities experience a bust like they've experienced over the last 7-8 months, bonds tend to rise, and that is exactly what happened. That's why we've had a major bull market in the bonds, even though most economists and analysts were expecting bonds to fall because of the end of the Fed's QE or bond buying program, but the exact opposite occurred. And the missing link here is that commodities were experiencing a bust, and that helped to boost bonds. Another relationship, and this tended to be more true before the QE era, before 2009, but in general, it is a general economics principle you should be aware of. Let's say if we eventually escape these wonky markets where QE distorts everything, but the idea here is that bonds trade inversely with equities or stocks. So if you have a big bull market in stocks and the economy is booming, it tends to lead to bond weakness. Bonds will sell off. And if stocks sell off, there's a bear market or recession, stocks drop, people want to buy bonds because it's a flight to safety and bonds rise. The other relationship is between commodities and commodity currencies. And commodity currencies is a term used to describe the currencies of nations that have economies that are very commodities oriented, usually exporting commodities. So Canada is one of them, Australia is another, New Zealand is another. Australia is a major iron ore exporter. They export iron ore and agricultural products to China. Canada is a major agricultural exporter too, also a major oil exporter, and that's why its Canadian dollar currency tends to rise and fall with oil. And New Zealand dollar as well. They export all sorts of products from wool to milk powder, believe it or not, as funny as it sounds. So my starting point when doing an intermarket analysis is looking right at the US dollar index. And this is not an actual currency itself. It is a proxy for the strength of the US dollar. And what it does is as I said earlier and a few slides ago, I said that think of the US dollar index as like the Dow or S&P 500, but for the US dollar. And what it does is it derives the value of the US dollar by comparing it against its major the currencies of major trading partners. So in this index, you'll have a very high weighting of the dollar versus the euro and the dollar versus the yen and so on and so forth. So because of this inverse relationship between among the dollar and these other assets, I start with the dollar because the dollar is the world's reserve currency, and it tends to be a major driver of global economic trends and financial market trends. So I would just start with performing a technical analysis of the US dollar index, including drawing a rising uptrend line, which is something I've been showing for a while. And you can see every time it touched that rising uptrend line, for example, in mid-October and also mid-December, I showed my followers this when it was happening. I said if the US dollar index bounces from here, it's going to crush commodities and non-US currencies, assuming the US dollar bounces off that. And it really does find a solid support there. And sure enough, that is exactly what happened, as I'll show you. So then this slide I made I made, I think, a few weeks ago. So since then, I showed, is this a possible pennant pattern? Yes, actually, it ended up being a pennant pattern, and the U.S. dollar index is quite a bit higher from here, as I'll probably show you toward the end. So that you can see how I do it in real time. So you can see that major bull market in the U.S. dollar starting in July 2014. It crushed commodities. And what we're looking at right here is the Dow Jones UBS Commodities Index. And this is just like the Dow or S&P 500, but for commodities. It averages many commodities from oil to gold to hogs to copper to wheat, etc. And the rising dollar pushed it over into a bear market. And you can see the commodities plunge that really started in earnest in early July, corresponded with the start of the U.S. dollar rally. So you can see the U.S. dollar rally started in July 2014. Well, that basically was when the commodities crash started to accelerate. So back to that other relationship, commodities versus bonds. You can see the commodities bust helped to boost bonds. Bonds prices soared, and it confounded so many analysts and economists because they said, what is going on here? We expected the bonds to go down. Well, the commodities crash is what happened here. And declining inflation expectations, which is good for bondholders who receive a fixed income, who do not want their fixed income eroded by inflation. So they don't want high commodities prices if you own bonds. That's the idea. So commodity currencies, including the Canadian dollar and Australian dollar, were slammed. You can see this is Canadian dollar sold off significantly starting July. No surprise there. The Australian dollar, just 2 months later, started to sell off significantly. For the same reason, iron ore prices started plunging. The U.S. dollar started to rally, so its value against the Australian dollar decreased in value relative to the U.S. dollar. So here's how I apply intermarket technical analysis. Step one is I want to identify correlated leading markets that move ahead of other markets. So for example, commodities and the U.S. dollar very often will lead the Australian and Canadian dollars. Next, I want to find chart patterns or other actionable technical information in the leading market. For example, it would be a bearish head and shoulders pattern or other types of patterns, including the pennant that I showed earlier. I'll show you shortly some charts on this. And then next, what I want to do is I want to look for a technical confirmation in the lagging market. So you want to look for a bearish confirmation in the Australian dollar, Canadian dollar after the bearish commodity signal was given. So here's the chart. You can see analyzing the U.S. dollar index. And you can see in August, there was another bullish technical break. You can see that was actually a consolidation pattern. There was a trading range similar to what I discussed earlier. And when the U.S. dollar index broke above there, that was a bullish signal for the U.S. dollar and therefore a bearish signal for other markets, other commodities, etc. And we kept on getting these bullish signals as the dollar kept on rallying, kept on bouncing off that uptrend line, kept doing it over and over and over and over. It's just been a relentless bull market. And then, okay, I just want to show you. So you could see the bullish signal was given pretty much around July when it broke above that first resistance, and then an added confirmation when it broke above that consolidation range in August. So we've given two confirmations once it finally broke out, and that was a sign that U.S. dollar index is probably going to really lift off from here. So the other leading market I analyze is the Dow Jones Commodity Index. And you can see this pattern formed last spring, 1 year ago, was a bearish head and shoulders pattern. And you can see there was a support level around 132 in this index, this commodities index, kept on bouncing, formed a shoulder in a left shoulder in March. I found formed a head in early May and a right shoulder in late June 2014. And once it finally broke underneath that neckline, which is the support around 132, that was a sign that there was a major technical breakdown. And you could short commodities themselves via this index, the futures on this index, or you can do what I'm about to show you. So you can see, just remember this, it broke down in early July 2014. And this is a leading market because it's the commodities index. Well, now we're looking at the Canadian dollar. And the top in the Canadian dollar occurred actually at the same time as the sell signal in commodities in early July. So that told you that basically marked the top in the Canadian dollar. So you can see right here, sell signal in early July in commodities marked the top of the Canadian dollar in early July. Very interesting, right? So for further confirmation, I like to look for confirmation in the lagging market. In this case, the Canadian dollar is the lagging market. You can see there was another bearish head and shoulders pattern that formed in the summertime. And the neckline was around 0.91 Canadian dollars to the US dollar. And when it finally broke down underneath that neckline, which was the support, that was in late September 2014. So that was another sell signal. And it occurred 2 months after you got that heads up from looking at the commodities index. Also, this is the Australian dollar. What's interesting, it formed its own head and shoulder, bearish head and shoulders. You can see the support levels around 0.92, kept on bouncing at that floor. Once it finally crashed through the floor in mid-September 2014, that was a sell signal, or at least a sell confirmation in the Australian dollar. What's interesting is that sell signal occurred 2 whole months after the signal in the commodities index. The commodities index sell signal was given in early July. And if you're interested in shorting, you were given 2 months of lead time to short the Australian dollar. So that's how it predicts, or at least forecasts, lagging markets. And you can trade the lagging market using these leading signals. So I look for confirming chart patterns among different markets, and it goes back to the bearish pennants we discussed about oil. I'm going to show you another principle. So you can see this is the Canadian dollar, and this is crude oil. Notice how they both form bearish pennants at the same exact time. And I wrote an entire column on Forbes.com just about these pennants. I said just watch these pennants, because if these break down, there's probably going to be another big move. And that is exactly what happened. They kept on falling and falling, and they've fallen further since I made these slides. So that's what I do, is I look to different markets to confirm one another, because it reinforces that signal, and it makes it much less likely that that there's going to be a fake out, that there was going to be a signal that, or let's say a market move that goes against you when you have multiple markets confirming one another. So we'll do the Q&A shortly, but I just wanted to discuss the idea and how you can go about learning even more advanced concepts. Of course, I discussed only probably 1% or maybe even less of what I know about these markets and how you can go about trading these. And there's so much more to learn out there, and so many different ways of profiting, and so many different tools for your trading toolbox, not just for Forex, but for futures, and these tools that you can apply for all the markets, whether you trade stocks on intraday, you're a day trader, or you are a bond trader, whatever it is. I want to teach you these tools. So I'm teaching what's known as a Phase 1 Forex course very soon. We're still deciding the precise date, but it's coming up very soon, probably within the next few weeks. So you're able to attend this for just under $1,000, and I'm going to give you the link for this right here. You can take a look and order directly from there. And this is a very good value, because you can make a significant amount of money in these markets. It's not hard to make $1,000 or tens of thousands of dollars over time in Forex and futures and other markets. So I'm going to be teaching you many of the techniques that I use, proprietary techniques that I've developed, including me being able to help you and you be able to ask me questions if you take this course. So I definitely recommend you come on in and get started on the path to being a very successful trader. And in time, if you keep building up your knowledge, who knows, maybe you could work for a hedge fund someday, or you could be a successful trader who trades from home, semi-professional. You can trade around your schedule, which is nice about Forex. You can still have a day job. You can place trades at nighttime. You can even day trade at nighttime. And I'm going to be teaching you how to do this and teaching you the elementary aspects, including more advanced concepts, everything you need to know just to get started, and giving you a very complete knowledge that you need to go ahead with this. And so you can click on that link I input right there, or you can also speak to an education advisor if you were interested. I'm going to get you a link on that right now if you're interested in custom solutions or discussing your trading needs further, and they can help you and guide you. Let me just pull up that phone number 1 second. Where is it? All right. And I'm also going to give you my email address here where you can email me and we can discuss this. But here's the number you can call an education advisor to discuss this Phase 1 course in further detail. Right there, 877-702-9237. And here's the email that I use for Cyber Trading University, Jesse at C2 Trading. And you can ask me questions or the education advisor so we can work through and help you out. And hopefully we will see you in my Phase 1 course and then teach you all the techniques that you need to know. All right, so now I'm going to have a Q&A discussion where you can ask me questions about Forex, global financial markets, bubbles, what I'm going to eat tonight, anything you want, within reason, of course. So, all right, someone said the phone number and email are not showing right now. All right, let me, I'm going to post it this way, and we'll see if this works. 1 second. Where is it? Does everyone see that link that I posted? Can everyone see the phone number I included? It should be in that little chat box. Okay, other people see it. Okay. Okay, good. Okay, good. I'm not going crazy. All right, wonderful. All right, so, well, I think a good starting point would be I want to discuss the column that I wrote this past weekend where on Forbes, where I was basically saying that there was likely to be a big currency move. I wrote this on Saturday, February 28th. I said why global currencies may be on the verge of a big move. And I was showing the pennant pattern that formed in the US dollar index and the pennant pattern that also formed in the euro because, as I said, they trade inversely, right? So it's not a surprise to see that they look like a flipped version of one another. There was a wedge in the Japanese yen. And since then, today, there was a very strong jobs report that came out in the United States that blew past all expectations. I'll answer all your questions shortly. I just want to review what happened because this is some big news. Look at this. This is the U.S. dollar index. It's at 97.75. So when I showed this my column, it was at 95.27. So you can see this pennant had predictive value. And here's the euro. The euro is at 1.12 versus the U.S. dollar. I'll show you what happened today. Whoops, I'm sorry, I just minimized that. Let me just pull that up. It's sold off very significantly. It dropped below 110, which is a major psychological support level, and it's now 108 versus the U.S. dollar. Also, other currencies that I discussed are experiencing major moves as well. This is the Japanese yen. Show that wedge. I said if the yen breaks down from this pattern and continues to weaken, it will likely, well, I was discussing that it means the yen's likely to keep dropping here. There has been an inverse relationship in the past between the yen and stocks, but today stocks also sold off because the jobs report was so strong that market participants became worried that the Fed's going to tighten rates earlier than expected. So you can see Japanese yen is breaking down, or it's in the early stages of breaking down. So I'm concerned, or I'm wondering if there's going to be further breakdowns similar to what we saw this past fall, a move like that. So there could be an opportunity for traders to short the yen. Again, no, not investment advice. Whoops. All right. Let's see. So here's the Australian dollar. Let's see what that did. So you can see because these non-U.S. currencies trade inversely with the U.S. dollar, they all fell today because the dollar surged right out of that pennant. And you can see Australian dollar. I don't know if you can visualize it here. I did draw it on some of the other some of the slides I had, where it was in a consolidation pattern. So now it's weakening. So I want to see if it's going to break below 0.76 to the U.S. dollar and keep dropping, similar to what it made in these other moves, these other bearish moves. Here's the Canadian dollar. I showed it's forming a pennant. I think there's going to be a big move when this finally breaks. And there has already been the start of it, what looks to be the start. It hasn't broken down decisively enough yet for me to say, okay, this is it. This is really the start. But you can tell it's really on the verge. So it's definitely tempting to want to short that, especially because the Canadian dollar is highly correlated with oil. Canada's a major oil exporter. You can see crude oil's down 2.05% today. So if crude oil maybe keeps dropping and then can try to touch $40 per barrel, that would certainly cause the Canadian dollar to break down even more from that pennant. And who knows, maybe we could see another sell-off like we saw in December and January. The Canadians would not be happy if that happened. Here's the British pound. You can see at this weekend, just a few days ago when I wrote this, it was hitting its 1.55 to the U.S. dollar resistance. And I said, you can read it right here, the text, I said it's trading in a range. I said if the U.S. dollar's breakout is sustained, the pound may bump its head at the 1.5500 resistance level and try to retest the January lows at 1.50. Let's see if that happened. Let's see if I'm a liar. Let's see if I know what I'm talking about. Oh, it happened. What do you know? We're right there within days. I didn't even expect it to happen this quickly. So now we're at a major support in the British pound. You can see it's at just above 1.50. It's probably going to try to test that, maybe drop a little below. If it drops below there, that would be another bearish signal. It could be an opportunity to short. But I would definitely consider that little discussion this past weekend a success. Let's look at the New Zealand dollar. It showed how the New Zealand dollar was at a major make-or-break point. I said that in the cyber group room where I do my updates for Cyber Trading University every afternoon. I said, watch 0.76. It's probably going to bump its head right there. And if it does, and if the U.S. dollar index continues to rally from that pennant, New Zealand dollar is probably going to sell off. Well, that is exactly what happened. You can make money on these moves. You can make very big money. It's you can see it right here in front of your eyes. The levels are there, and I can see them. I can spot them. I don't need indicators, even though I look at other things like that. But I guess I've gotten to the point where I can train myself to just look at charts. I don't even need to draw them. I draw them for the sake of students so that they can understand it better, or for my readers. But I just visualize it at this point. All right, let's look. Oops. All right, what is this? All right. Let's look at what else we have here. So if you want to read through my column, I know I'm probably going to maybe do an update this weekend on it, and I'm going to give you guys the column so you can read through and see how it's done. So, all right, so let's go to the questions now. Here we go. A lot of people I know here who followed me for many years. I know Alex. I know quite a few people. All right, so Alex asked me, what happened to the U.S. dollar index? Well, what happened was, and this is going back for the last 7-8 months, is you have the simultaneous tightening of U.S. monetary policy along with the weakening, or sorry, loosening of European monetary policy. So the Fed is looking at raising interest rates soon, probably within a few months, especially after today's jobs report. They also ended quantitative easing a few months ago, and that causes the dollar to rise. At the same time, the European Central Bank was dropping interest rates. They had negative interest rate policy, and then they're now starting up their own quantitative easing policy. They're going to be printing in a few days from now 60 billion euros per month from now, or a few days from now, up until September 2016, and that weakens the euro. And what it does is that capital is going to flow somewhere, and it's flowing into the U.S. dollar, which is the beneficiary of that. So that's what it's the differential between these two countries' policies that cause the U.S. dollar to rally. All right, let's see. Someone asked me, to place trades, do you need a license? No. At least in major countries, you don't. I mean, I don't know if you're in some small countries that maybe have specific policies, but in the majority of countries, you don't need any type of license to trade. It's just a matter of opening up a brokerage account and having the money, of course. And, of course, number one, you need to have the knowledge. You can't just, well, I mean, you can do anything you want, but it's not necessarily a successful strategy. You need to know what you're doing. Forex and futures, these are sophisticated markets, more sophisticated than stocks, and it's not something where you can just buy and hold for the long run. You really need to be on top of your game when it comes to technical analysis. Otherwise, you can get hurt, And if you're not aware of these principles, don't even bother trading until you have the knowledge. I'll save you money. Don't do it until you're really well versed. And that goes back to my training course, the phase 1. I'll be bringing you up to speed to that point where you'll be prepared eventually to start trading and eventually making money. So let's see the other questions. All right. Someone asked me, what's my position on Russia right now? It's very difficult to trade Russia, especially after the plunge. Russia, it's become very volatile. Many traders do not have access to trading the ruble anyway, or many Russian instruments. You can trade in the United States, you can trade Russian ETFs like RSX, but I wouldn't want to be getting in this late into this trend. Really, if you wanted to trade Russia, short Russia, the time to do it was about a year ago. Though there are other markets that are now starting to move, which I think have a greater probability or just a better trade. Whereas Russia, I feel like that's kind of a little bit long in the tooth now. And it's rebounded very sharply. But for now, I don't like to deal with dead cat bounces. It'll probably bounce around for a little bit. I think the money to be made has already been made in Russia. Now it's time to go on to other moving markets. All right, I'm just going down the list of questions to answer for you. Let me see. Adam asks me, do you have any technical indicators which you think are worth using over other websites, etc., that you use? I'm a fan of technical indicators. I'm not anti-technical indicator like some people are. When I first started out in my own trading and analysis back in 2001, I was very heavy on indicators, until I realized that these indicators are just derivatives of price. They're really, and they're lagging on top of it all, because by the time the price is factored into these mathematical formulas, you're looking at old data. So there's no more current data than the current price. And that's why I've really trained myself to get to the point where I'm skilled looking at just raw price. Though I do, in my phase 2 workshop, which you can take once you're finished with phase 1, I show a proprietary system that I developed that works quite well. And it does utilize some of these oscillators, but not in the way that most people think. It's quite different than people use it. It's pretty contrarian, and I find it to be very useful. I do like to pay attention to on the longer time frame, intermediate time frame. I do look at moving averages. Like in the stock market, I look at the 200-day moving average just to ascertain the overall trend by looking at the slope. That's one thing I do like to use. But you can see these moves that I called a few days ago and have been doing all along. I didn't use any indicators. I don't need indicators to tell me major psychological support and resistance levels and when there are confirmation moves, when it breaks above or below on high volume. So that was my goal, is to get to the point where I don't need those secondary indicators. But I do think there's some value in it. I like to look at Bollinger Bands. For example, when Bollinger Bands are useful for determining times of high volatility and low volatility and when there's likely to be a volatile move coming up. And there is value of them, don't get me wrong. And in terms of software websites I like to use, I mean, I like to use finviz.com. I'm going to give you the link to that. It's a free site. It's pretty basic, but again, for the type of trading I like to do, analysis, where I'm eyeballing it, it does fit me quite well to look at it. Of course, a Bloomberg terminal is always going to be preferable, but for most of you traders who are novices, who are just getting started, just go on finviz.com. I just posted it there. Poke around, click on the charts, learn and look how markets trade, how they move. Read the news. Just start immersing yourself in market movements, and being aware of what is happening in the first place is probably half the battle. All right, let's see. Bruce says he's a new follower, wants to know about silver, spent his career as a municipal bond trader. Great to have you here, Bruce. Nice to meet you. You're asking me what I think about silver. I wonder if you found me from my gold and silver column this past weekend. You may have. Well, what do I think about silver? What's interesting, I wrote a column a few weeks ago when gold was at just under 1,300 an ounce, and silver was just under 19, and I was showing how the smart money, or the commercial hedgers in the silver and gold futures market, were actually bearish. You can see the green line underneath this chart. You can see they were quite short on that silver, and this is gold. So they had, in gold futures, they had 200,000 net short contracts. When I saw that, I said, I am very suspicious of this rally, especially the fact that gold's coming up to this major psychological level. It's a round number, 1,300, and the fact that there's this inverse relationship between the U.S. dollar and precious metals. And for me, I suspected that there was going to be a U.S. dollar breakout to the upside. And for me, when I saw that, I thought that was going to be the death knell for gold and silver. And I reiterated that in my column this past weekend, and that's what happened. So you can see a significant sell-off in gold. Now, what is very interesting when I'm watching in silver is that it broke below $16 an ounce, and it goes back to my principle of round numbers. 16 is a psychological number because traders and journalists and algorithms look at round numbers like 16, and it's a threshold. And when a market crosses above and below, it tends to trigger a lot of trades. So the fact that the U.S. dollar index is breaking out and silver dropped below here is not a good sign. I think there's a chance silver could try to drop back down to, at a minimum, maybe 15, which is the low that was reached back this past fall. If 15 breaks, silver could drop even further. It could drop maybe, who knows, maybe low teens, maybe even 10, depending on how far the U.S. dollar index rises. Pardon me. Gold dropped under 1,200. It's another major support level, as I discussed in one of the slides. this 1200 level goes all the way back to mid-2013. So we're at 1167 today. Gold is down 2.41% today at 1167. Now, if that low that was reached back in November, if that's taken out, I believe it's at 1145, that would not be a good sign for gold, and we could see gold could drop as low as 1,000. We'll see what happens if that happens. If it drops below there, who knows? It could drop down to even further. Yeah, Alex, you're right. I need to make ginger tea for this cough. That's exactly it. And I need some rest and better weather. All right. Let me look at the other questions. Toby asked me, do I think Greece will eventually leave the euro? It's very hard to speculate on events like that because you need to know what you need to know what political leaders are going to do in the future. And it is hard for me to say precisely that they're going to do this at this time. Even they don't know. You know what I mean? Like, think of it from the perspective of, if you're a politician, you may not even know what your next move will be a month from now, 2 months from now. So how am I going to know? I try to avoid scenarios where I don't have a high probability of getting right. So when I make predictions, I only make predictions on things that I know for certain. One of those are bubbles. Like, when I see what looks like a bubble, economic bubble, I'll predict and say this is going to crash because it's really very basic. It's pretty obvious. When it comes to market movements, short-term market movements, I don't predict because I won't guarantee. I won't say I guarantee you gold is going to plunge under 1,200 because I don't know with that type of certainty. Neither does any other sentient being, even though they may claim they know. They really don't know. It's a probability game. So I can tell you there's a high probability this will happen. But for me, I also want to know my limitations. I know where I'm willing to where I'm likely to be wrong. For example, if I suspect something's going to happen in the markets and it doesn't happen, I'll have an exit strategy where I say, okay, all bets are off, get me out. I'll take a small loss. I am not here to prove my ego or anything like that. So I only predict certain events in the markets or in economics. Let me see. Gary asked me, do I think silver will drop underneath 15? Again, it goes back to me. I don't predict markets because in my mind, predictions are guarantees. But for me, I look at probabilities. For me, I want to see what happens when if it touches 15 first. I take it step by step. I don't try to jump so many steps ahead. I want to see if it can get to 15 first, and then we'll take it from there. So now it's dropped below 16, which means $16 is the overhead resistance. So let's say if it would rise back above 16, it would negate that bearish signal. But if it does not, the next obvious support is 15. How it acts when we get there probably depends on the US dollar index. If it drops below there, that would definitely not be a good sign, and I would probably like to be on the short side in some capacity there because you can see 15 is a support that goes all the way back to early 2010. And if it drops below there, it could drop as low as the next major round number just because market participants tend to look at round numbers. So it could be $10, it could be 14. I mean, we don't know. I can't tell you. I can only just go with the momentum. Once it starts dropping, I would probably use a stop. I would probably use a trailing stop loss order. And the idea is we'll see how far it can keep going, but I don't even try to place a number on it. I just follow the trends. Miguel asks me, do you see any crash in the near future? It goes, well, okay. Something happened here that was a little concerning today. And this goes back to something I discussed in a column this weekend. I was showing how the S&P 500 dropped below its December high. So just if you can visualize here, just draw a horizontal line connecting the late December high. And that was a support level, and the fact that the S&P 500 sliced underneath that, that's not a good sign. That's definitely a negative sign from a technical perspective, unless it can break back above and negate the bearish signal. But for now, I'm concerned. That's a technical breakdown. I cannot predict. I cannot predict and say, all right, this is going to be the crash. I can only tell you what's likely to happen based on short-term momentum. So right now, I'm not liking the way it's looking just from that perspective. Plus, this goes back to confirmation, using different markets to confirm one another. The Dow broke below its 18,000 support level. That's a major round number. It was also the high in late December. That's not something you'd like to see if you're long or bullish. I wasn't expecting anything, but for me, I was watching to see if it was going to try to bounce off 18,000 and maybe try to rally above. But now, after today's jobs report, traders have become concerned about an earlier than expected rate hike, and basically removing the punch bowl away from the party early, and that's what caused today's bearish action in equities. All right, let's see. That's just great. I see so many longtime followers. I'm so happy to have you guys here and have a medium where I can actually speak with my own voice. All right, let's see. Someone named Hum asks me, can I explain the 3 lines underneath the silver chart? Sure. And this is something I'll discuss in greater detail in my courses. I can't give everything away for free right now, but I'll just discuss in general. Right underneath here is the Commitment of Traders report, and it shows the positioning of various futures market players. So you'll have the commercial hedgers in green. You'll have large traders of funds in red, and you'll have small traders, basically retail traders, in blue. And I have various ways of where I watch the markets using the positioning of these various groups of traders, and who I follow and who I fade or basically do the opposite of. And I discuss this in greater detail in my courses, and have many different trading techniques that I show in there. I'm excited to really develop those and hopefully get a lot of people in there and educate everyone. Let me see. Someone named Jeff asks me, how can someone with 5 years of trading experience in their own account find work as a trader, probably on Wall Street, etc.? That's a very good question. That's something that a lot of people are always wondering. I mean, if you can take your trades and your account and you can produce reports showing what you've done, and then I would say I'm a big fan of social media and using social media to network. And this is something I've done extensively on my own, really to mostly for the sake of my anti-economic bubble activism, which is something that's very near and dear to my heart, because I do believe in it so heavily. I'm very scared about what's going on in the world. I'm trying to build awareness and trying to build a movement, and people just don't quite see what I'm seeing, and it's scary that you have so many economic bubbles. And the idea is I'm using social media to network with people, including LinkedIn. I find LinkedIn to be very helpful, and you can sometimes request people on LinkedIn and kindly contact them and maybe ask them for advice. A lot of it is networking. I think one good way of doing it, and I'm saying this based on my own experiences, maybe open up a blog, open up a trading blog, and get on social media and post your trades on the blog. And then there are industry professionals who are on Twitter and Facebook and StockTwits and Scutify. It's another major social network that I'm on. And you can go on in there and you can speak with those people. And if they're impressed by what they see, they may say, hey, you seem like you have promise. Do you have a resume handy? So I'm just saying this based on my own experience, and this is how I've gotten many opportunities myself, is just through building my own social network, and that's how Forbes contacted me. They saw They saw how many followers I have on social media, and they said, uh, it's very interesting. It's proof that you've had enough of a following who want to listen to what you say, and we'd like to see what you can do with a column. And other opportunities have come this way too. So I'm a big proponent of social media. That's all I'm going to say. I mean, it's worked for me. I'm practicing what I preach. There's many other ways of going about it, but also if you can get big enough with your blog and your commentary and make some good calls, and you can actually get quoted in the media yourself, that does definitely help boost credibility. Like if you can say, oh, I was quoted in Forbes, CNBC, Business Insider, and you go to a job interview and you print that out, it does carry some weight, So I would say that's an opportunity. And someone named Joseph says you can check out the apiary fund. They will let you invest their money. Interesting. Okay, that's I guess it's like an angel investor type of situation, but for traders, sure. I mean, there's also prop trading firms that they let you trade with their money, and it's different arrangements. I'm not really an expert on these. There's different types of prop trading firms. Maybe Google the term prop trading firm and look and find if there are any in your area, and maybe go about that way. All right, let's see. David asks me, longtime follower, thank you. Good to see you, David. Oh, okay. Do you see the establishment resistance to chart analysis approach similar to the resistance against Austrian economics and how they're both based on human behavior rather than mathematics? That is an actually excellent question. I hadn't really ever thought of it in those terms, but now that you say it, it actually really does make sense. Because it seems like it's the same neoclassical economists who are resisting Austrian economics and the truths contained within it, which I'm an Austrian economist, as many of you may know. And it seems like those same mainstream economists and analysts and journalists resist. For them, they won't even give chart analysis a chance. It's not even like they've disproven it. Same thing with like Austrian economics. It's not even like it's been disproven. They won't even give it they won't even entertain the thought, and it's a form of intellectual snobbery, and it drives me nuts because for me, my goal is to keep an open mind and learn as much as I can and see what works and what doesn't. And you can see I'm calling these moves using technical analysis, of course, having an informed opinion about what's happening in the economy, but you can see it's not random when you see something like where I showed you, like in the U.S. dollar, I showed that what looks like a triangle pattern, and then sure enough, there's a breakout. I mean, is that random? How could this happen so often where it's just sheer randomness? There's definitely something there, and it's human psychology. That's a very good point. I think I'm going to analyze that a little bit more. So, I mean, let's put it this way: the mainstream way of looking at economics and finance does not work. If it worked, we would not have had the 2008 financial crisis, and certainly the crisis that I believe is coming ahead. So it's not like they have got it all figured out, because they do not. And their way of thinking is wrong, just like they think we are in an economic recovery. Oh yeah, stocks are going up. It's a recovery, and jobs are being created. Oh yeah? Isn't that exactly what happened 10 years ago when we had the housing bubble and credit bubble, and you had all this artificial economic activity. Jobs were being created, but they were being created in bubble sectors like housing and mortgage broking. And were those real jobs? Yeah, they were, until they were lost when the bubble popped. And I feel the same thing is happening now in various bubble sectors, from tech startups to real estate in some sectors again. I just don't trust what is happening, and it's these same mainstream neoclassical economists who are saying, no, this is it, trust us this time, this is a real recovery. But I ain't buying it. Jeff says, corn is a nice symmetrical triangle. If I am interested. Yes, I am interested. I love looking at these. Yeah, I can see that. That is that's a good point. You can see, if you can visualize maybe two lines, it looks like it's converging together. Sure, yeah, I think it can move. It's very possible that once there's a final breakout, of, pardon me, breakout or breakdown, that it could experience another directional move. Good point. Thanks. I do have. Someone's asking me for my Twitter handle. I do have a Twitter handle. Yeah, I'm gonna post it right here. It's twitter.com/thebubblebubble because I discuss bubbles. All right. Yeah. Adam was saying on Forbes, says my website's thebubblebubble.com. It's not working in any browser. Sorry about that. You know what? I have to have my IT guy fix my website. I think it actually got hacked by I don't know if it's someone in the Philippines or New Zealand. It was some country. Someone didn't like what I said about bubbles in their countries. I could be wrong. I don't know if it necessarily got hacked or if it's just a plugin just is not working. But I have to revamp my website, thebubblebubble.com. I use mostly social media in my column now, and I have to update all the articles on my site anyway. But thanks for reminding me. I need to get my IT guy on that website. So I got a new follower in Jeff. Jeff just followed me on Twitter. Awesome. Thanks. I'll follow you right back. And if any of you want to follow me, please come on, and I will follow you back. And we can discuss trading, and you can follow my real-time updates. I post these things for free very often. Adam followed me on Facebook. Sure, yeah, follow me on Facebook. There's many different avenues of following me. Here's my Facebook. So many different ways to follow me. Alex says, come fishing up north. Yes, I'm down for that once this bronchitis is over. Until then, I need a little more warmth. Thank you, though. I love to meet followers, so I think it's great. All right. Let's see. Nick asked me, are there certain markets that experience breakouts that are typically more extreme than in others? Very often, markets that make some of the most extreme moves are ones that are less liquid than others. Like you'll have a small, thinly traded, illiquid market. Let me try to find you some examples. Maybe something like rough rice. I know back when pork bellies used to trade, they used to make very sharp moves because it wasn't a heavily traded market like the euro, for example, and it would just chop and slop all over the place and make pretty sharp moves, but moves that really are not that great for trading. So I tend to avoid the thin illiquid small markets or small illiquid stocks. I like to stick with markets that have enough liquidity to make more fluid moves, basically. All right, let's see. All right, so there's lots of other questions. I mean, we'll definitely be doing a lot more of these webinars. I do them about every other Friday, every 2 Fridays. So this is certainly not the last one I will be doing, and I try to switch up the topics of these different webinars just so it's not the same thing over and over, because otherwise I don't want you to be bored, and I don't want to be bored myself. Try to throw in a little tidbit of information here and there that's different. But for the real meat of what we're discussing, just definitely check out that link and come on into the course, and that's where we're going to go into the real meat and potatoes, and that's where you can get started to getting on your way to being a solid trader or analyst, either one. All right. All right, thank you, everyone. So hopefully you enjoy your weekends, and yes, I will have a recording on Monday. We're gonna post it on YouTube, and we're gonna send it out via email to everyone who attended this webinar, and I'm also gonna post it on my social media, so you will not miss it. Do not worry. So you'll get an email, and you can watch that YouTube again. So hopefully you'll be in my future webinars, and we can discuss and everything like that. All right. Happy trading. Enjoy your weekend. Get some rest. Take care.